Hey everyone, welcome to today's Explainer. Let's dive right into a topic that is absolutely crucial for anyone out there working for themselves. You've finally escaped the W-2 prison to work for yourself. I mean, most people dream of this exact moment, don't they? Leaving that rigid, traditional employment structure in the dust. And there's this incredible euphoric feeling when you first break free. You're out on your own, you're setting your own hours, generating your own profit, and everything just feels so incredibly optimistic. You're building something that is entirely yours from the ground up, relying purely on your own grit. But here's the catch. Being unprepared for what actually happens next in the tax landscape, that can completely derail the dream. It leaves so many people wondering where all their hard-earned cash actually went. To really understand why this hits so hard, we need to skip the economic theater. As CPA Brian from Hidden Tax so brilliantly explains, here's the raw truth. When you're a standard 1099 worker, you are stuck paying both halves of the Social Security and Medicare bill. Think about it. Back in the W-2 world, your employer quietly paid half of that for you. You never even saw it leave your paycheck. But out here in the self-employed world, you pay the entire thing. Both halves of that massive bill come directly out of your pocket. You are essentially footing the bill for the employee portion and the employer portion, all by yourself. So what does this all mean? It means you have got to protect your financial fortress. You simply cannot let a 15.3% tax drain your resources completely unchecked year after year. The IRS isn't going to just politely step back and leave you with enough capital to grow your business or feed your family. You have to actively learn the math to legitimately protect your net worth from this massive drain. You worked way too hard to escape the corporate grind, right? So it is absolutely time to build, fortify, and actively defend your financial fortress. Which brings us to the ultimate weapon in this fight. The S-Corp election. Now, I know that sounds like dry tax jargon, but it is actually a highly effective, entirely legitimate strategy used by savvy business owners everywhere to level the playing field. The S-Corp allows you to step up, take control, and literally split your income into two distinct categories: a salary and business distributions. By executing the structural split within your business, you are actively keeping a huge chunk of your money protected from that massive self-employment tax. It's honestly one of the single most powerful moves a profitable independent worker can make. There's just a fundamental difference in how these two setups are actually taxed. Let's look at the standard 1099 worker. They're trapped paying that full 15.3% on all of their profit. Every single dollar they earn gets hit by that hammer. But the S-Corp owner, they completely change the roles of engagement. By utilizing this strategy to legitimately split their income, they drastically lower their total tax liability. It's a direct mathematical advantage. It completely alters the trajectory of their net worth because it allows them to keep their capital inside their business where it actually belongs. Structurally, here is how this core mechanic actually works in the real world. We take your total income and we split it into two distinct buckets: a reasonable salary and business distributions. This legitimate division of your money is exactly how you flip the game in your favor. Instead of throwing everything into one giant pile that the IRS gets to tax at the absolute maximum rate, you're deliberately allocating those funds. You pay yourself a fair, standard wage for the actual work you do, that's your salary, and the rest of the profit flows directly out to you as a distribution of the business's earnings. Okay, lean in for this part because this is the real aha moment of the entire strategy. You only pay that 15.3% self-employment tax on the salary bucket. The business distributions, they are completely safe from that specific tax. No way, right? Let that sink in for a second. By simply routing a portion of your profits through the distribution channel, rather than taking it all as standard self-employment income, you are legally bypassing that 15.3% drain on a huge chunk of your money. That's the math. That is exactly how you legitimately nickel and dime the IRS and preserve your own wealth. Let's pull this all together. Please do not let a silent tax stall your net worth explosion. You've got the tools and the structural knowledge right now to fight back and keep what is yours. You just have to stay highly disciplined in how you structure your business. Trust the math because the numbers absolutely do not lie. Use this exact strategy to build your legacy and protect your wallet over the long haul. And as CPA Brian reminds us, make sure to subscribe to Hidden Tax for more hard truths on aggressively defending your finances against these crazy hidden traps. So, the multi-million-dollar question is, are you ready to legitimately nickel and dime the IRS in 2026? You've seen the math, you clearly understand the income split now, and you know exactly how to build and defend your financial fortress moving forward. The timeline is right in front of you, and the strategy is crystal clear. It is time to take control of your hard-earned profits. Thank you so much for joining me for this explainer. I am absolutely rooting for you, and I hope you go out and have a highly profitable, mathematically protected day.